Thank you for joining the Resilient Cyber Show. My name is Chris Hughes, and today I'm joined by Peter Walker from Carta. Peter, thanks for being here, man.
Hey, Chris, good to be here. Thanks for having me.
Yeah, we were just chatting off air. I've been following you, I don't know, it's got to be at least a year and a half now. And I'm not in the venture world per se. I'm a cybersecurity practitioner, but I like to watch the market, the ecosystem, the startups, all the trends of the world I live in. And I came across your content, like many others, I suspect, in many different industries, and have been following you since. I can find it fascinating, all the things you're sharing. But for folks that don't know you, I dare say don't know Carta. Can you tell us a bit about yourself and a bit about the team as well?
Yeah, definitely, man. So I run the insights team at Carta. Taking a step back, Carta began life as an equity management platform, which means we're the place that founders go to give equity to employees, to sell equity to investors. Anything that has to do with the ownership of your business, you would manage that on Carta and our software platform. But it's expanded way beyond that. We now run the back office for 3,000 venture funds in the US. We do the same thing for hundreds or close to hundreds of private equity funds. So basically, the goal for Carta is to become sort of the backbone infrastructure for any private fund, be it private credit, private real estate, private equity, or venture. And then, of course, we have this amazing advantage of having 60,000 startups on the platform. Like more than half of all venture-backed companies use Carta in the US. So that gives us this really cool data set that I get to play around with every day and then make sense of just in public.
Yeah, those insights are incredible, and it's across many different industry verticals, many different size companies, you name it. So I definitely recommend folks check it out. I'll throw some links in the show notes here. One thing I wanted to talk about to kick us off here, I thought it'd be kind of interesting to get your take on this is there's an individual in the cyberspace. His name's Caleb Sema, longtime security leader, become, venture capitalist. And he posted today saying security marketing is officially gone consumer. He said, we're out of the best tech era, and now it's the war for eyeballs. Buy the biggest booth, make the most noise, outlandish round sizes, even at seed stage. I'm curious, what do you think when you look at the ecosystem and in terms of, the best tech versus just making the most noise, being the most present and so on?
I would maybe push back on the idea that best tech always won in the past. That's never been true. Maybe outside of Google, I guess. There's always some combination of the quality of the product, the quality of the marketing, the attention that you can grab in the ecosystem. And then the recent thing, which I think is a little bit new, is just king making by VCs. And by that, I mean VCs who pick what they want to be the category winner and then pump them so full of cash that it kind of feels like they're inevitable, and it lessens the demand for everyone else. I do see that behavior far more often today than I used to, but that is still separate and apart from the product quality. I put it this way: I don't think it's possible to win a category with a terrible product. That's just not the thing. But is it possible to lose a category when you have the best product? Yes, it definitely is.
Yeah, I agree with you there. And I've worked at different startups and advised various startups, and I feel like it's much to the the frustration sometimes of a co-founder or CTO that it's not only about the product or having the best tech. Like you do gotta market, but it's a delicate balance too, right? You could have the best marketing, make the most noise, and then people use the product and it doesn't deliver. And that could lead to frustrations too.
It's always the in venture, it's always the joke between the first time and the second time founder, which is the first time founder cares only about product and the second time founder cares only about distribution. There's obviously got to be a balance of both.
Yeah, well said. So I know you, like I said, you look at a lot of different industries and verticals and so on. When you look at the ecosystem and say like cyber in particular, do you see it valued differently than the broader B2B SaaS, in terms of, a premium on valuations and things like that? I know, sometimes there is for talent, right? For example, I'm curious your take on that.
There tends to be, I looked at this morning actually. So there does tend to be a little bit of a premium in terms of median valuation for cybersecurity companies at the earliest part of their journey. So call it seed, Series A companies. As an example, the median SaaS company on Carta today at the seed round is valued at something like $15 million pre-money. So you add in the $3 or $4 million that they raised, and you're talking about call it a $19 million post-money valuation for a SaaS company. By the way, most of those SaaS companies are using AI in some way, shape, or form. It's pretty rare to find a software company that's not. Whereas on the cyber side, it's more like 16 million pre-money, so a $1 to $2 million bump for cybersecurity. Fewer raises, but the valuations are a bit higher. And that pattern repeats itself at Series A. And then it kind of sort of merges at Series B where there's not as much of a distinction. So yeah, I think that generally speaking, I think that cybersecurity has been one of the more active sub verticals within this software boom over the last, call it 2 years. But it's not as though cyber is, flying ahead and the rest of SaaS is being left behind. It's still a pretty close race.
Yeah, you said the kind of the bingo buzzword, I guess, of the last several years, which is AI. I didn't want to jump right away, but in the industry, like in my world of cybersecurity, it feels like it's dominating everything, and you kind of threw it out there in the broader VC and startup ecosystem too, in terms of fundraising, investment, valuations, and so on. Like it seems like AI is pervasive. Like every startup is now listed as like being AI native or an AI for security company or securing AI. Like when you look at this ecosystem, or not just cyber, but even more broadly, do you feel like there's a bit of like a FOMO, or like you kind of have to use the word AI or be associated with AI to raise funds or to make some noise or be kind of recognized in some way?
Absolutely, man. It's getting kind of annoying, if I'm being honest, but people are just playing the game that's on the field, which is AI companies are getting big premiums over non-AI companies across basically every part of software. So sales and marketing, cybersecurity, enterprise SaaS offerings, dev tools, whatever it is, AI beats non-AI in terms of the clarity of the story to investors and the willingness of those investors to keep investing. That doesn't mean, I think the difference between now and say 2023, it really did feel for a while in 2023 that you could put the word AI into your pitch deck and the investors were like, oh my God, how exciting. That's not the case. Like they've caught up, right? Every investor has a different take on what qualifies as the AI they're looking to invest in. Some of them only invest if you're, building foundational models. Some of them only invest if you have proprietary data to tune those models. Some of them only are totally fine with you using it to automate a part of your business, but the core of the tech isn't AI yet. There's all sorts of different approaches. I just, when I talk to VCs that are generalist software investors, it's been a solid 9 to 12 months since they've seen a pitch that didn't have AI in it in some way, shape, or form.
Yeah, it seems to be the case. Like I said, in security, every company now is AI for security or securing AI, or it's just like it's everywhere you turn. And I think the fatigue is real in our industry too.
Do you think that the folks that are deep in security, how do they view that? The view from the other parts of venture is there's not a lot of practitioners who are somehow super annoyed by many founders that I talk to are saying, I wouldn't have started this company but for AI. And now this is like opening up a new opportunity. Is that the same with security practitioners, or are they a little bit more?
It's a bit of a mix, honestly, and like, and some of folks may get annoyed or kind of feel insulted by this, but like it's a bit of both. Like myself and there's many other founders, like you said, like they're like it's a pivotal time, a once in a lifetime opportunity. Like AI is really redefining what we can do in cybersecurity, and then you have some of the practitioners who almost don't want to accept the inevitable that like things are changing and like we can do things we couldn't used to do, and maybe we don't need as many people, or maybe things don't need to be as manual. And I feel like some people are really struggling with accepting that, even if it is the reality.
Yeah, it's tough when a technological change comes along and it threatens the way you've done things. I think that's like a human response, not just a cybersecurity practitioner one. So yeah, it's a real moment of change for a bunch of people.
Yeah, I hate to say it, but it's almost like kind of adapt or die. Like you can fight it, but you're fighting like a wave that's incredibly strong, and it's going to be hard.
I tell founders all the time, it's like, look, if you're pitching physical products like hardware, et cetera, if you're building something in the real world, an AI story is nice, but not always required. If you are building software, you need to have an AI story or have an incredibly clear reason why you're avoiding one. And I don't see a lot of founders coming up with an incredibly clear reason.
Yeah, I agree with you there. I wanted to ask you too about, like, I know you put out, kind of a 2025 recap, and in there were great slides around equity pools and equity allocations to initial hires. Like, I know you may not have specifics in cyber per se, but like, there's a lot of a war for talent in cybersecurity, right? Getting the, kind of that 10x security engineer, that kind of thing. What are the trends you saw in that world of equity pools and equity to early hires and so on?
Yeah, so I actually took a peek at this. Taking a step back, in general, I think that there is a the biggest shift in venture-backed companies over the last 2 years is how many people they hire, which dictates so much of their capital spend, their burn, et cetera, et cetera. And they're just hiring fewer and fewer people. That is true across every single industry, no matter where you look. I think in our latest data, it used to be that a Series A company on Carta, when they raised that round, call it 2 to 3 years ago, they probably had something like 24, 25 employees. Now it's more like the ones that are raising this year will have 16 employees, and the ones that are raising in 2027 are probably going to have 11 or 12 employees. That's a massive jump, right? And that lack of hiring dictates everything else across compensation. So when there are fewer new hires, every new hire is scrutinized more closely. There are not multiple offers for those candidates. Therefore, the compensation tends to drift downward because it's a buyer's market. Supply and demand for talent is just what it is. When I looked at cybersecurity, I thought two interesting things, which was one, cybersecurity salaries are still rising, not awesome, like 1 to 2% a year, not keeping pace with inflation, but they're still going up a bit. And then equity is actually, for cybersecurity professionals, doing a little bit better than most other places. I wouldn't say it's AI engineer level better, but it's pretty good compared to, say, your average marketer or operations person. People just got to keep in mind, if you have friends who got startup offers in 2021 and you look at their equity, and then you look at the equity that you might be offered today for a similar role at a startup that's similar sized, there's going to be a 40% haircut to that equity. Do not compare yourselves to people who got hired 4 or 5 years ago. That was a totally different market where things were just kind of wild.
Yeah, I got to ask, because some people, don't live and breathe and watch the market, the kind of the quote unquote ZERP era, 2021. I know you kind of called that out in your report. What made that such a unique time? Why is it such a kind of an outlier?
It was like a confluence of 8 or 10 different factors that came together to produce this bonanza of venture cash. So one, obviously, we had a pandemic. That pandemic scared the crap out of people for 2 months in startups. That April, May 2020 time was there was, you remember Airbnb did major layoff. Everybody was super worried what happens to business at this point. And then everyone got online permanently, it felt like, and all the digital businesses ripped. And so then there was this frenzy of excitement. There was an idea that there was going to be a digital pull forward, all these years of growth were actually going to come in months instead of years because of the way the pandemic changed things. There was obviously some government intervention in terms of interest rates at 0% for many long time. And then there was government spending that also kind of felt like people in the economy had a lot more cash. And those cycles tend to just feed on themselves, especially in venture. So you got companies, I don't want to pick on individual companies, but you got companies that clearly were not worth very much at all, that were being valued 100, 150, 200 times their current revenues, which just doesn't make any sense, really. And what happens when you overvalue a ton of companies, at some point, what goes up must come down. And they did come down when interest rates changed in 2022. The valuations of many startups just kind of collapsed. And so people, and by people, I mean employees mostly, were kind of left holding equity that they were granted at some really high valuation that just isn't worth that anymore. So a lot of employees actually got burned on the equity side by the dreams of how exciting this startup was and kind of the disappointment that came after the turn happened.
I can't help but, I know we're not in that era now and things aren't exactly the same, but there are maybe some parallels, in the AI sense, right? There's a lot of, I can't in AI security operations in cybersecurity, there's, I think 80 plus startups tackling this one problem, right? It's and I'm sure many people are being sold that dream, we're going to be the one, we're going to win the category, that kind of thing. When you look at the industry, are you seeing the same thing where premium valuations on acquisitions of AI, centric companies and so on?
Yeah, we're right back in it. Venture loves a bubble. We just kind of have to have one. And we're definitely in an AI bubble now. When I say AI bubble, I don't mean that there's going to be no winners from these times. There will be generational companies that are built using this AI technology right now. We're already seeing it, right? I would not call Anthropic a bubble company. There are going to be companies that radically reshape the world that are built right now. But what happens is there is this general inflation of valuations. There's more capital chasing what happens to be fewer companies now. We're concentrating capital in fewer companies, which pushes those valuations up. And if you're an employee, you need to realize that just because your company had a buzzy Series A doesn't mean that you're going to make money out of that equity. The modal outcome, the most likely outcome, is still that equity is not worth anything. Something only like, out of the Series A pool, something like 5 to 7% of those companies will have an exit, either M&A or IPO. So it's not a lot. So don't count equity as cash until you work at a very, very late stage company where it's very clear that you're going to go public.
Yeah. Honestly, you're right on cue because you used the word "go public." My next question was, in the cyber market, like there's some folks that kind of like the Peter Cartas of Peter Walkers of cyber, right? Like they live and breathe the market in cyber, and they've been talking about how we're seeing companies stay private longer. But now things may be starting slowly to change, some IPO ambitions and so on. Like, what are your thoughts on that, kind of dynamic? And what do you think 2026 and 2027, for example, may look like?
Yeah, I mean, you've seen, I think, a couple different things, which is cyber has had some of the buzziest acquisitions in the industry across all of startups. I mean, Wiz as the typical example there. So there has been sort of a buzz around exits, either M&A or IPO in the cyberspace. I do think that it's always the case, but I think it's probably even more so now. The main path for exit will be M&A, often by strategics. Cyber doesn't fit the private equity roll-up strategy as neatly as some of the other places in venture. So it's private equity buyers are not as active in cyber as some other parts of venture, but like big startups or big tech are the typical acquirers for cyber businesses. IPOs, I mean, who knows? When I talk to bankers, they're always excited. They're like, yeah, this is going to be the best year ever. I'm a little bit more skeptical. What will change the IPO market is what everyone is kind of talking about, which is if one of 3 names goes public: SpaceX, Anthropic, OpenAI. If any of those companies end up shooting it and actually getting out to the public markets, I think you will see a fast follow from some smaller companies as well. The window is open, but tricky. And more companies are just saying, for personal or company reasons and some for market reasons, staying private longer is not actually a huge problem for us.
Yeah, it's funny you said a few things there. Like one is in about the strategic acquisitions in our space. There's these behemoths in the world of cyber, like CrowdStrike, Palo Alto, folks like that, Zscaler, and so on, that have done a ton of strategic acquisitions, especially around like AI security the last year or so, year and a half. And your point about potentially staying private longer. There's been some companies, cyber companies, I think, that tried to go public recently, and they got kind of punished by the market, even though they were doing well in their reporting and stuff. And I think like some are seeing that there's a benefit to maybe just staying private, or reduced kind of levels of scrutiny and so on. So I think you're spot on there. I was going to ask you too, like we're seeing the rise of secondary markets, knowing that there was kind of like that narrowing of the window, right? When it comes to like looking at that, that trend and thinking about like how founders or investors, early investors, right, maybe thinking about liquidity, what do you kind of see playing out there?
It's a really big topic across all venture. I mean, cyber for sure as well. Secondaries used to be this part of the market that was very murky, opaque, kind of disreputable almost. Like, oh, taking secondary is somehow like you're not believing in your own company, or something must be wrong if people are selling. What it's become is just a fairly standard part of the playbook for late stage companies to get some liquidity back into the ecosystem before they IPO. We've seen an explosion of company sponsored liquidity events, often called tender offers, where the company sets a price. The company tells, hey, employees, you can sell up to 20% of your equity. And they find the buyers, they set the price, and they execute that as a trade. That's happening, you see companies like Stripe that are doing a tender offer every year, basically. And so there's almost like super private companies where you have no liquidity. And then this like slice of big private companies where you have kind of semi-public liquidity, where maybe you get an opportunity to sell once or twice a year. And then public companies where you could sell every day. And that middle of the market, the middle of the liquidity secondary market, I think it will change the way that investors and founders think about liquidity. I already know when I'm talking to smaller venture funds, they are actively having secondaries as a part of their financial projections in a way that, 5 years ago it was IPO or bust.
Hey, actually, I wanted to ask you about that. You've been posting about like those tender offers, and this is a naive, like I guess maybe a naive question for someone who doesn't live and breathe this like you do. Like,
Sure.
what is the benefit to a company? Like, why are they doing that before they IPO? Like, what is the benefit or the appeal of making a move like that? Obviously, for the employees, some may say, I want the liquidity now, let's do it. Others may say, I'm going to wait, right? Like, I'm going to wait till, but like, what's the benefit? Why does the company do that?
I'd say that there are multiple reasons why a company might be excited about a tender. You mentioned the first one, which is employees. If an employee has been with the company for 7, 8 years, this company is doing really well, they've got a lot of investor demand, well, maybe that employee does deserve to sell a portion of their equity, pay down a mortgage, buy a house. It can be a life-changing event. And that doesn't have to happen, when an IPO is 13 years after incorporation. That's a hell of a long time to make an employee wait to turn paper money into real money, which is what equity ends up being. So that's one. Two, candidly, because of the way that the dynamics in the late stage part of the market work, where certain names rise to the top and they just have bidding wars. There are so many investors right now knocking on Anthropic's door saying, we would love to give you money in any way, shape, or form. Please let us invest. Well, if you have that external demand, it can be the case that the company goes, well, we don't actually want to raise any more capital, but if we want to execute some secondary shares, or we don't actually create any new shares, we just allow people who hold them to trade them. That's a good way to alleviate the pressure from outside investors for some of these really in-demand companies. And then the last point, founders want liquidity too. It used to be the case where if a founder sold a little bit of their company at Series B or Series C, the rest of venture would be like, oh, how terrible. Like, they don't believe. That's not the case anymore. It's kind of, especially for the most in-demand companies, it's kind of expected, like you're going to take some cash along the way. Some people thought if founders sold, they wouldn't care anymore about a big exit. Now I think the thinking is, let's let this founder take care of their personal financial life. And that allows them to have the stability to shoot for an even bigger outcome. And I totally agree with that second approach, to be honest.
Yeah, I think those all make sense. I wasn't sure, why they would do that, but I could see it for the founder. It gives them a second win, right? Like, kind of let's keep it up. Like, here's take some stress off of you personally or whatever, right? And then to your point, it's almost like a retention of talent, in my opinion. Like, hey guys, you've been here with us on this journey. Here's an opportunity, right, to take some money off take some chips off the table, that kind of thing.
So Clay just did a tender offer. Clay is a sort of sales automation startup, outreach, et cetera. They just did a tender offer, and explicitly in the thinking from the founders, which they posted online, it was, it used to be that people thought giving employees liquidity would make it more likely that they're going to leave. Okay, made some money, time to go find another job. What they're saying is that what they've found over they've done, I think, 2 or 3 tenders, is that employees are actually higher retention for the employees that sell a little bit because they feel so valued. They go, oh, this is a place that cares about me financially, is not going to make me wait 12 years to have any liquidity. They want me to do well now. And then as the company keeps growing, I have the opportunity to keep doing well. Because employees don't sell. If you have 100 shares, they're not allowed to sell those full 100 shares. You can sell typically 20, 25% of your holdings in a tender offer. So they're still invested in the company. And I just think that's a more modern, more, reasonable approach to things.
Yeah, it's funny. It reminds me of that cartoon. It's almost like, what if we invest in them and they leave versus like, what if they stay?
What if we invest in them and they stay? Exactly.
Right. Like, people are more fired up. They're more committed to the mission, the journey, and everything like that. So it makes a lot of sense to me.
And as we just mentioned, fewer hires, like, it's not an easy job market. If you're an amazing OpenAI AI researcher, sure, you can join wherever you want. But if you're not, this isn't a fantastic market to go find a new job in. So yeah, your company is treating you well, giving you liquidity, giving you a path, and it's doing very well because the only companies that really run tenders are the ones that are doing quite well. I think staying is the obvious choice in most cases.
Yeah, I think it makes a lot of sense. So I want to ask you kind of last question here, knowing that you have access, I think it was 60,000 companies is what you said. You know, you can have a peek behind the curtain. You're kind of watching all these different trends and things like this. Like, as we look to the year ahead, like on, I hate to do stereotypical kind of predictions, but like, what do you think the big changes will be? And what do you think will be like, probably stay very similar to as it was last year?
I think, so one of the stories that people have been telling about venture over the past couple of years is that AI is cool. We all get it, but AI companies are running a little bit of a shady operation. And what they mean by that is the revenues are real, but are those customers going to stay, right? Because if I'm using Cursor, I can very easily use one of 8 other coding tools and IDEs, and I can switch tomorrow. So there's no moat, is what people are saying. I think 2026 is the year where we find out which AI startups have real moats. They've been through a couple renewal cycles. You can see their retention really clearly now. And I think some of them will prove, hey, we have really great retention, actually. Doesn't mean that they're making money yet. Like, don't expect them to all be profitable for sure. But I think that's one question that will kind of get resolved this year. The next question, the biggest question across venture is like, what happens to, there's this tension in venture between the big funds who have all the money, Andreessen, Sequoia, their names, and then all these little emerging managers who are just trying to find early stage founders. So mega funds versus emerging. That dynamic, I think, will kind of come to a point this year where there's going to just need to be new strategies from the small funds to combat what the big funds are doing. The big funds are playing really interesting capital games, and they dictate the market. They can invest into a pre-seed, a seed round, and then they can just keep investing in that company all the way through their IPO. And they don't really care when that IPO is because they can get liquidity earlier on. So I think what happens to emerging managers who many founders rely on as their first check, that will be one of the biggest stories of this year.
Yeah, I wanted to pull on that thread actually with you a little bit, because I know there was, what was it, Andreessen Horowitz, I forget the percentage, but it was an insane amount of the percentage of overall venture capital raised, like in the last year or whatever, even when they announced their latest fund, right? Yep. Like, what are some strategies for these, managers like that are trying to compete with? Because like you get, like to your point, you said this throughout the conversation, you get associated with one of these leading funds and leading brands. Like they have the network, they have the reach, they have, they have all of it. They have the capital. Like, how do you try to compete? Is it more favorable terms? Like, what do you do?
Yeah, I mean, if you're a founder and you take a check from Andreessen, you get access to their credibility. You get access to their network. You have literally hundreds of people in their fund who are thinking about, how do I make a launch video for you? How do I connect you to the next enterprise customer? Like, it is a real massive advantage. They're trying to build what beyond a venture fund, like effectively a venture asset class manager. It's a very impressive strategy they've executed over the last, call it 15, 20 years. If you're an emerging manager, I think you have to lean exactly the opposite way, which means you have to be first. You got to be helping these founders when they're not even sure they're going to make a company yet, right? You got to find them pre-incorporation. You got to be helping them ideate on the problem space, the market space, et cetera. You got to be their first call at the very earliest stages. And there are emerging managers who have fantastic personal networks who can like get into those things. I think the hidden thing that people don't realize is when you were talking about investing into founders in the 80s and the 90s, it really was incredibly difficult to find them. We didn't have all the tools and ways to track companies that we do now. Now it's, finding, you can go to any venture fund and they say, yes, we are monitoring thousands of companies and trying to see which ones we want to invest in. That's very, very different than 20 years ago. So like getting there first is, I think, the most obvious and best strategy for the emerging managers. The people that are really tricky is, how do you make money if you are a Series A or a Series B fund in the middle, where you're not going to be first, but you're also not a mega fund? Like, carving out that path, I think that's going to be challenging.
Yeah, excellent point. So I think, like to your point, some of these funds are not even, they've become they have entire media arms, right? Like you get put on the platform, you get exposure, through that. It's such an interesting dynamic. And to your point, the smaller funds and managers, I think it's going to be a very concierge, high touch, white glove, kind of hands-on experience to try to compete and get those teams early. So awesome stuff, man. I really appreciate you coming on and sharing all the wisdom, and please keep the insights up. I know I appreciate them. A lot of other folks do too. And hope you have a good one.
Absolutely, Chris. Happy to join you.
Take care.